low-volatility investments outperform their high-volatility counterparts.
That sounds counterintuitive. Isn't it common belief that higher returns come with higher risk?
Absolutely, and that's what makes the low-volatility anomaly so fascinating. While conventional financial theory, particularly the capital asset pricing model, suggests higher expected returns are linked to higher risk, historical data tells a different story.
This anomaly isn't just a theory. It has been observed repeatedly in various markets, leading to questions about assumptions we once thought were solid.
Wow, what does that mean for everyday investors?
It means there could be a smarter way to approach investments, especially when the stock market has its ups and downs.
I can't wait to learn more about how this plays out historically.
The capital asset pricing model emerged in the late 1960s, presenting a clear link between risk and return.
That sounds straightforward, but how did it perform in real-world applications?
Almost immediately, researchers began challenging its predictions. Studies found that the expected relationship between beta and returns wasn't as strong as CAPM suggested.
Indeed. The work of economists like Fischer raised questions about the zero beta return concept, offering a more nuanced perspective.
It's intriguing how theories evolve over time. What did this lead to?
In 1972, the work of Jensen, Black, and Scholes showed a flatter relationship than CAPM predicted, marking a pivotal moment of empirical challenge.
It was a crucial turning point that set the stage for deeper scrutiny.
And then what?
Robert Haugen and James Hines further solidified the hypothesis that stocks with lower volatility yielded higher long-term returns.
So, even in the face of established theories, evidence started painting a different picture?
Exactly. And what's even more fascinating is how this anomaly persists across different markets and sectors.
The evidence supporting the low volatility anomaly spans an impressive 90 years in U.S. markets.
90 years? What does that data show?
Essentially, portfolios sorted by risk reveal that those with the lowest volatility consistently outperform their higher volatility peers.
The data is compelling, isn't it? Many scholars and market practitioners have validated this consistency since the early 1970s.
That's incredible. Does it hold true globally too?
Yes. Studies from various international markets echo these findings, confirming it's not just a localized phenomenon.
Remarkably, this anomaly is observable across sectors, indicating that low-volatility stocks are a resilient strategy regardless of economic climates.
It sounds like this theory has undergone rigorous testing.
Indeed, extensive research has provided robust statistical backing for the low-volatility anomaly.
So, what's stopping more investors from jumping on this bandwagon?
That's a complex question, and leads us to consider the explanations behind this anomaly, which can reveal deeper insights into investor behavior.
Several theories have emerged to clarify why low-volatility investments seem so appealing.
What are these explanations?
One key idea revolves around investor constraints. Many face leverage and shorting limitations, as explored by Brennan and later tested by Frazzini and Pedersen.
Exactly, and beyond constraints, relative performance becomes a driving factor too.
How so?
Investors striving to outperform benchmarks can gravitate towards low-risk stocks, resulting in increased demand.
That creates a cycle where low-volatility stocks are favored, further enhancing their performance.
Interesting, but what about agency issues?
Professional investors sometimes have misaligned interests, which affects investment choices.
Absolutely, and behavioral biases also come into play. Overconfidence can lead investors to overvalue flashy stocks.
Sounds like there are a lot of psychological factors influencing decisions.
For sure. And we'd love to hear from our audience about any additional insights or suggestions regarding these biases.
Those contributions could offer even more dimensions to our understanding.
This is all quite revealing. I can't wait to learn what's next.
Stay tuned. There's much more to uncover about the implications of these insights in our next chapters.